De-dollarization is no longer a distant theory. It is a trend that is becoming more visible across the global economy. In international trade settlement, the share of transactions conducted in US dollars has been gradually declining over a long period of time. This shift does not appear suddenly in one country or one market. It shows up consistently across multiple indicators. One of the clearest reference points comes from IMF COFR data, which tracks the composition of global foreign exchange reserves and shows a long-term downward trend in the dollar's share. At the same time, central banks around the world have been adjusting their reserve portfolios, reducing exposure to dollars while increasing holdings of gold and other assets. These changes suggest not a collapse, but a steady reassessment of how much reliance on the dollar is considered optimal. Beyond reserves, similar patterns can be observed in actual trade flows. In some bilateral trade relationships, countries are increasingly settling transactions in non-dollar currencies, particularly where political risk, sanctions exposure, or transaction costs are a concern. Energy and commodity markets also reflect this shift, as new contracts and payment options introduce currency choices that go beyond the dollar. None of these developments alone signal the end of the dollar's role. Taken together, however, they point to a world where the dollar is no longer the only unquestioned default. So, to understand what this shift really represents, it is necessary to first clarify what de-dollarization actually means. De-dollarization does not mean abandoning the dollar or replacing it with a single new global currency. It refers to a broader set of choices aimed at gradually reducing the central role the US dollar has played across the international economic system. The core idea is not substitution, but adjustment. For decades, the dollar functioned as the automatic default in trade, finance, and reserves, often without an active decision being made. What is changing now is not the existence of the dollar, but the assumption that it must always sit at the center. In place of a single dominant option, multiple currencies and settlement choices are beginning to coexist. This shift is not driven by market forces alone. It reflects deliberate decisions by governments, central banks, and national-level institutions responding to risk, exposure, and long-term strategy. Importantly, this is not a sudden break or a clean separation from the dollar-based system. It is a gradual, selective, and partial process that unfolds unevenly across regions and sectors. So, the more important question is not whether this adjustment is happening, but why it is accelerating now. One of the most important forces behind this acceleration lies in how the dollar and the global payment system are positioned within international power structures. The United States occupies a unique role where control over the dollar and its payment networks can function as an extension of foreign and security policy. Most international dollar transactions move through global banking networks, and in many cases, they are directly or indirectly connected to U.S. financial regulation. This structure is not theoretical. It reflects how cross-border dollar payments are actually processed in practice. International dollar settlements typically rely on relationships between global banks and correspondent banks. Through this process, transactions are often routed through financial institutions that operate under U.S. regulatory oversight. As a result, when sanctions are imposed in response to geopolitical conflict, security concerns, or violations of international rules, the impact is not abstract. It can translate into real consequences, including restricted access to dollar payments, frozen foreign exchange reserves, and limited or blocked access to international messaging systems such as SWIFT. These mechanisms have been applied in concrete cases. In 2022, a significant portion of Russia's foreign exchange reserves held abroad was frozen following the escalation of sanctions. Countries such as Iran, Venezuela, and North Korea have faced long-term constraints on their ability to access dollar-based financial channels. What this reveals is a structural reality rather than a political slogan. The moment a transaction relies on the dollar, it can fall within a framework where U.S. regulatory and sanctions authority may apply. From this perspective, de-dollarization is not driven by ideology or hostility toward the United States. It reflects a practical effort by states and firms to reduce exposure to the risk of disruption, freezing, or exclusion from critical financial channels. At this point, however, sanctions risk alone does not fully explain the speed at which this shift is unfolding, because another powerful pressure is also at work. That pressure comes from U.S. monetary policy and the global effects it produces. When the Federal Reserve, the central bank of the United States, raises interest rates, the decision is made to address domestic inflation and economic conditions within the country. Yet in a dollar-centered financial system, that decision does not stay within national borders. Higher interest rates increase the relative attractiveness of dollar assets. As capital seeks higher returns, demand for the dollar rises and the currency strengthens. A stronger dollar, however, creates immediate strain elsewhere. For many emerging economies, external debt is denominated in dollars. As the dollar appreciates, the cost of servicing that debt rises, even if local economic conditions have not changed. This increase in dollar-denominated debt burdens tightens financial conditions and limits policy flexibility. The effects do not stop there. Higher U.S. interest rates raise returns on dollar assets relative to the rest of the world. As investors respond to that shift, capital tends to move back toward American markets, often at the expense of emerging economies. When funds leave those markets, local currencies weaken, exchange rates become more volatile, and financial stability comes under pressure. In some cases, this combination raises the risk of currency stress or broader financial crises. At the core of this dynamic is a structural imbalance. The Federal Reserve raises rates to stabilize prices at home. But because the dollar sits at the center of global finance, that same action reshapes financial conditions across the world. Still, short-term shocks alone cannot explain the deeper transformation taking place, because a larger structural shift is also unfolding. Over time, the global economy has been moving away from a single center of gravity toward a more multipolar structure. For much of the post-war period, economic influence was heavily concentrated around the United States. That concentration is now gradually loosening because growth, trade, and investment are increasingly distributed across the Global South, the Middle East, and large parts of Asia. As these regions expand their role in global production and consumption, their exposure to external financial conditions also grows. This change alters how risk is perceived. When economic activity is spread across multiple centers, reliance on the currency of one country begins to look less natural and more costly. What once felt like a technical default starts to resemble a strategic choice. As a result, the question shifts from how to operate within a dollar-centered system to whether exclusive dependence on a single national currency still makes sense. In many countries, that question has moved beyond theory. It has become part of institutional debate and policy planning, where currency use is evaluated alongside resilience, autonomy, and long-term stability. In this context, de-dollarization emerges not as a reaction to one shock, but as a response to a changing global structure. Against this backdrop, it becomes necessary to look more closely at which countries are actively choosing to reduce their reliance on the dollar. One group that often draws attention is the BRICS countries. Across these economies, there has been a growing effort to expand the use of local currencies in trade settlement and to reduce automatic dependence on the dollar. Public discussion sometimes focuses on the idea of a shared currency. In practice, however, such proposals face significant constraints, and the real emphasis has been on diversifying payment and settlement options rather than creating a single alternative. China offers a more concrete example. Through its long-term strategy to internationalize the yuan, China's currency, the government has worked to increase its use in cross-border trade. This effort extends beyond manufactured goods into energy and raw materials. In particular, transactions with Middle Eastern partners have begun to include yuan-denominated settlement or yuan-based pricing options. These arrangements do not represent a wholesale shift away from the dollar. They reflect a gradual expansion of currency choice in specific transactions and specific relationships. For Russia and other heavily sanctioned states, the motivation has been more immediate. As access to dollar-based financial channels became increasingly limited, alternatives were no longer optional. Settlements in the ruble, Russia's national currency, the yuan, or in third-country currencies, emerged as practical ways to keep trade and finance functioning. Taken together, these cases show that de-dollarization is not driven by a single ideology or a coordinated global plan. Instead, it reflects different responses to sanctions exposure, transaction costs, settlement reliability, and political risk. At this point, the question shifts from who is discussing de-dollarization to how these choices are being implemented in practice. In reality, de-dollarization does not move through a single channel. It unfolds through several concrete mechanisms that operate simultaneously. One of the most visible is the diversification of trade settlement currencies. In a growing number of transactions, the dollar is no longer the only option, as payments are settled in currencies such as China's currency, the yuan, the Indian rupee, the UAE dirham, or the euro. These arrangements are often limited to specific partners or sectors, but they reduce the automatic role the dollar once played. Another mechanism appears in how central banks manage their reserves. Over time, some have adjusted the composition of their foreign exchange holdings, lowering the share held in dollars while increasing allocations to gold and other currencies. This shift is gradual, but it reflects a reassessment of concentration risk rather than a sudden loss of confidence. A third channel involves payment infrastructure itself. Some countries are working to reduce dependence on existing global financial messaging systems, which banks use to communicate payment instructions by developing regional or national alternatives. These efforts are not about replacing the entire system overnight. They are designed to ensure that basic transactions can continue even when access to traditional networks is disrupted. Taken together, these tools show that de-dollarization operates through practical adjustments, not dramatic breaks. Still, the presence of these changes does not mean the dollar is about to lose its central role, because there are reasons it continues to hold that position. One reason lies in the scale and liquidity of the U.S. Treasury market. It remains the largest pool of safe assets in the world. The market is both deep and highly liquid, allowing large volumes of capital to move in and out without disruption. During periods of uncertainty, global investors continue to treat U.S. Treasuries as a final destination rather than a risk. A second factor is the legal and institutional framework that supports the dollar. Confidence in contract enforcement, property rights, and transparent accounting standards underpins trust in dollar-based markets. What matters here is not the currency alone, but the reliability of the broader system in which it operates. A third factor comes from network effects and switching costs. Trade, finance, commodities, and derivatives, financial contracts used to manage price and currency risk, are already deeply interconnected through the dollar. Changing that structure involves far more than choosing a different unit of account. It requires new systems, new hedging arrangements to manage currency risk in thinner markets, sufficient liquidity, and coordination among trading partners. Those costs rise quickly, and they vary across countries and industries. As a result, de-dollarization tends to move slowly and selectively, rather than through sudden or comprehensive shifts. In that sense, the acceleration being observed does not point to the end of the dollar, but to a change in how the global financial order is evolving. What is taking shape today is not a collapse of dollar dominance, but a period of recalibration. The dollar remains central, yet the system around it is gradually accommodating more alternatives. Whether this pace continues will depend on several conditions rather than a single cause. The sanctions environment is one factor, as broader and more persistent restrictions increase incentives to diversify financial exposure. Interest rate structures matter as well, because prolonged periods of tight monetary policy amplify pressures beyond the United States. Geopolitical dynamics also play a role, shaping trust, alignment, and perceptions of risk across financial channels. Energy and commodity trading structures add another layer, since pricing and settlement choices in these markets influence currency demand over time. Together, these forces suggest a global financial order that may be shifting from a single center toward a more layered structure. For the United States, this does not signal an abrupt loss of influence. Instead, it points to a world where capital flows, interest rates, and market behavior respond to a wider range of options. The direction of this transition will depend on how these factors interact over time, rather than on any single turning point. Global de-dollarization, then, is not the end of the dollar, but a signal that choice is expanding within a dollar-centered world.